All right, y'all. Welcome this morning to the Family First Life SkyPoint Get to 20K call. My name is Stephen Yee. I'll be going over the mortgage protection in-home with you guys. I will be recording this call for the folks that are on here so that you guys have any questions, you can always get back and see how it's done. I'm going to share my screen really quickly to show you what I use in the home. These documents are very accessible wherever you want to go. So let me do this, share screen, boom. All right, y'all see this? So this is the financial inventory sheet that I always use. This is a sample lead card of what I went through this weekend. So just to give you a heads up, client's 44, wife is 34, mortgage amount is 234, right? Phone number, whatever it is, I'm gonna go sit down with them for mortgage protection. So I'm going to explain to you literally where the appointment starts for me. All right. So when I get into the home, I literally pull up the lead card and go, hey, this is what you sent. And I slide it over the table. I grab my state license and I go, this is my badge. And they look at it. I don't care if they do or not, because it's just a picture of me and my license number anyway. Right. After they do that, I basically start the financial inventory. Now for me, I do my financial inventories in this booklet. So I collect all my clients' financial inventories all in here. Why? Because I rather have it than having it loose paper. I can actually have it in chronological order of who I sit down with. So like if a client calls me and says, hey, you put this coverage in place, and I sat down with them 2 weeks ago, I'm not going to remember what I wrote them, right? So the easier thing for me is put it in a binder, make them sign the accept or decline form. And it's really that simple. So I'm going to share my screen on my iPad and explain to you literally how I start mortgage protection. All right. Can y'all see this? Hopefully you can. All right. So I don't build any rapport until I get through the application. Right. So like I make this look almost as I want to say an interrogation, but like an interview. Okay. So I'll literally sit down with this client. Their names are Cecil and Catherine. So I'll literally start, after I show them the lead, I'm going to start writing tax color. Boom. We're good. All right. So Cecil, how young are you, Cecil? I'm 44. Perfect. What about your wife? Her name's Catherine and she's 34. Right? Cecil, what's the balance on your loan? $234,000. $234,000. Awesome. What's your house worth? House is worth $300,000. Okay. Was this a purchase or a refinance? It was a purchase. Awesome. 15, 20, or 30-year loan? 30. What was your interest rate, man? Oh, it was a 3.25. Dude, that's a good one, right? How long you lived here? 1 month. Okay, cool. Gotcha. So you have about, 65,000 equity in the home. What's your monthly payment here? $22.74, right? Okay, great. Now, do you guys make extra payments or do you just pay it as is? Oh, we plan on making extra payments. Perfect. That's premium for me right there, right? This next part of how I explain this quote unquote legality of how people die in California is very important. Now, your state laws might be different, but every state has probate, right? California just happens to suck way more than everybody else. So I'm going to explain it to you just like I explain it to the clients. I'll say, Cecil, are you the only one on the loan, or you and Catherine are on the loan? And he'll say, no, it's just me. Got it. So I'll X that out. Are the both of you on title, or is it just you again? Most of the time, lenders are so quick to close and put loans into escrow that they don't want additional paperwork. So they will almost never put the spouse on there. So many times for me, the answer is no, right? Do you plan on having the house in a trust? What's a trust? Got it. That basically means to me that you don't have one, okay? So Cecil, let me explain to you what happens in California if you were to pass away. So let's just say that your lender is Loan Depot, and when you pass away, they get a death certificate. They look at the loan and they go, Cecil's no longer here. He's on the loan. So no one else is on the loan. Let's go look on who's on title. They look on title and they go, it's only Cecil. Catherine's not here. Guess what? Now they can start the foreclosure process if they wanted to, because it's kind of like having a bill. Like, I don't know if you had a bill before, Cecil, where, the bill was in your wife's name. And when you try to call in, they ask for verification for your spouse or the person that's actually on the account. Well, she can't do that because you're gone. Does that make sense? And he goes, "Yup." And I'm like, so the only way for her to stop the foreclosure process is that she has to go to probate. Now, California will help you, but they don't do anything for free. So how does probate work? They take 4% of the property value. So your house is 300,000. 4% of that is $12,000. Okay. And then you have to spend about 2 to 3% in attorney fees, because you're going to have to fight them with attorneys. It's going to be a 9 months to 12-month process, and you're going to drag your family through that. Does that kind of make sense? So the reason why I'm here today, Cecil, is because mortgage protection was designed that if something were to happen to you, the house will, one, never go back to the lender, because you have about $65,000 of equity in the home. Like, you wouldn't put that in like Chase Bank, and then when you die, just left it with them, would you? Of course not. The other thing is, we don't want the house to end up in probate and make you drag your family through the mud. Does that kind of make sense? That's the reason why I'm here today. Okay. So with these mortgage protection plans, I work with 25, 30 different companies. Big ones like Mutual of Omaha, Americo, Transamerica, AIG, John Hancock, just to name a few. I can insure someone that's 85 and healthy, or someone that's 40 with cancer. I can insure a very, very wide range of people. Does that kind of make sense? The other thing too is, my job today is just to see what type of programs fit you, and if it makes sense, then we're going to put in an application for coverage. All right. So, Cecil, do you smoke? No. Awesome. What about you, Catherine? I don't smoke. Awesome. What do you guys do for work? I work as an engineer. Awesome. What about you, Catherine? I work as a stay-at-home mom, or I'm a stay-at-home mom. Okay. Gotcha. Cecil, what do you bring in monthly income after taxes? Net. On your own, without your wife? I bring in about 8,000 a month. Okay. And what about you, Catherine? Do you bring in anything, even though you are a stay-at-home mom, your value was way more than Cecil, right? Like, he has an 8-hour a day job. Your job is like 18 hours a day. Am I right? So, some people that, they do work from home, they have, they do little small side incomes. Do you have any of that? No. Perfect. Gotcha. No big deal. So right now, right after that, I seen that the income discrepancy is 100 to 0 or 75 to 25, right? Where one person, sometimes it's most of the times it's the husband, but sometimes it can be the wife. I'll literally stop right there and kill off the primary income earner, right? So I'll say, perfect, Catherine, let me ask you a question. Cecil doesn't make it home tomorrow. How are you going to pay off? How are you going to stay here? And I just shut up and I let them look at each other and tell me how. Well, I can't. He might have an insurance policy at work, but I'm going to go through the exclusions on that, right? But how would you stay here, Catherine? And not only that, it's just you and your daughter. She's 3. This is a 4-bedroom, 3-bath house. Like, would you want to stay in this big of a place? Right? Why am I saying these things? Because this might dictate the type of plan that I'm going to put him in. If she's not going to stay there, why would I pay the entire mortgage off? I might just put her in an equity conservation critical time period type of plan, right? So I'm going to ask her and say, if something were to happen to Cecil, what would you do? Would you want to stay here? I mean, I would like to stay here, but I don't know if I could. Gotcha. If you weren't to stay here, where would you go? I would move him back with my mom or something, my sister or whatever it is. They're local, whatever it is. Got it. So like, I'm keeping mental notes of what she would do, right? Because if she died, he'd make the mortgage just fine. And then I would look at Cecil and be like, hey, just to let you know, you are 100% the liability in this home. And like, you guys are looking at it like, why would you say that? Because he is. If he wasn't to come home, his family's on the streets. Does that kind of make sense? So for me, that's where I always tell, like, especially if it's a man, they hate hearing stuff like that. I'm like, Cecil, you are 100% the liability in the home. I have to make sure that I take care of you more than anybody else today. Does that kind of make sense? He says, yep. I'm like, perfect. So I continue. And I was like, do you have any life insurance that's private, that's not work related? Right? Notice how I worded that question. Do you have any life insurance that's private, that is not work related? And they'll look at each other and go, no, because what I have is from work. I'm like, perfect, that doesn't count. And I'll put a big 0 and I'll exit out, right? And then I basically explain to them, I'm like, hey, work coverage is great because you can get your salary multiplied by 2, 3, 5 times, whatever it is. You can get it for like 10, 15 bucks a month. The only problem is it's a group insurance policy. You don't have that policy. The HR department at your company does. And then not only that, if you were to leave that place and go work somewhere else, you lose your insurance policy. The conversion from going, from a group insurance policy when you retire to having it on your own, that's very, very expensive. And then the last thing that most people don't know too, Cecil, is because your insurance policy is paid through your payroll, the tax benefit is actually taxable. And then your wife's going to have to claim that as income. And so you're not like, let's say you have a $100,000 policy, she might get like 65 of it, right? So I tell people that because that is actually true in California. Okay. So life insurance should be tax-free unless the money that you're paying with is taxed. It's tax deferred. So let's just say they do have 100,000 of some type of coverage, right? Oh yeah, I have 100,000, policy. Okay. Is it term, is it whole life, whatever. Oh yeah. Who do you have it with? Oh, I have it with Primerica. Gotcha. Your cousin sold you that, or your friend or family? Yeah, it was a buddy of mine that I went to school with. Cool. I'm not going to go shit on their policy right now. There's no need to, right? But then I'm going to look and I'll be like, 100,000 doesn't even cover a balance in your loan. And not only that, I always tell people this: life insurance and mortgage protection go hand in hand with one another. Yes, they are the same. Mortgage protection is life insurance. But I'm going to explain to them this way. What is your largest bill, Cecil? It's your mortgage. It's almost everybody's largest bill. It's my biggest bill. It's all my clients' biggest bill. It's your biggest bill, right? So if the mortgage protection policy can eliminate your largest bill, your life insurance would go actually further. Not only that, if mortgage protection wiped out the complete mortgage of your loan, let's say it paid out $234,000 because you passed away, guess what your wife still has every single month? She has utilities, and twice a year she has to pay property tax, even though the house is paid off, right? That's where your life insurance comes in. And I'm going to tell you a story, Cecil. I had a client up in Palmdale, and what happened was the only life insurance policy they had was a mortgage protection policy. So he was driving on the 14, got in a head-on collision. He passed away. The insurance company paid off the house for the spouse. But the only problem was she was a stay-at-home mom of a 9-year-old, and she's never worked in her life. So guess what? Yes, the house is paid off, but now she has no idea how to live. Does that kind of make sense? That's the reason why they go hand in hand together. So, because you already have coverage is a smart idea. Not only that, when I start running some numbers for you, can you go grab that for me? Okay. And I move on to the next. And I say, do you have anything that acts like life insurance with a beneficiary? 401ks, IRAs, stock accounts, managed accounts, anything like that? Nope. Oh, shoot. Pen. Nope. Awesome. Perfect. So the both of you are pretty young and healthy, but I still got to ask these questions anyways. Have either of you had any heart issues, heart attack, stroke, cardiomyopathy, congestive heart failure, anything heart related, defibrillator, stents? No. Gotcha. X that whole line out. Anything with like a pacemaker, heart valve, disorder, aneurysms? Nope. Anything with cancer? Nope. Pain meds? Nope. Anxiety, depression? Nope. Cirrhosis, hepatitis? Nope. Okay. Any diabetes? Nope. Any asthma or COPD? Do you guys take any medication? No, we're young. We're pretty healthy. Gotcha. Not available. When was the last time you guys went to the hospital, seen a doctor? We haven't. It's been a while. We went for like an annual checkup or something. Gotcha. And at this point, this is where I show them the apply, do not apply. Okay. So before I show numbers, I go right into, hey, this is the process. This is what we're going to do. Now, I usually write this on the back of a lead card. All right. So I don't have enough space right now. So I'm just going to show you what I'm going to draw it up on the side because I still need to run the numbers on the side. I say perfect. So my job is real simple. My job is to find out if you qualify or do not qualify for coverage. It's really easy. If you qualify for coverage, I'm going to show you a few options. And if you like one of those options, you can either apply for coverage or decline coverage. Okay. If you apply for coverage, we do what we call a pre-check. That pre-check runs your prescriptions list, right? We're not going to send a nurse to draw blood, pee in a cup, speak to your doctor, do any of that. We're just going to take a look at your prescriptions. If that pre-check flies through and they give you an approval, then you have 30 days to make your final decision. Now, what can you do in those 30 days? You can increase your coverage. So let's say you pick the lowest one and you wanted to increase it and go up, you could. Let's say I'm so good at selling that I made you spend more money than you wanted to, and you got to decrease the coverage. You can do that as well. You can also replace the coverage, which basically means I don't like this plan. I like this one. Let's go with that one. All right. I never say cancel. Don't say cancel. In the next 30 days, you can cancel your policy. That's stupid. That's asking for a chargeback. You shouldn't do that. You can replace the policy. We can rescind the offer, but I'm not canceling the insurance coverage. Does that kind of make sense? And then I say, does this kind of make sense to you, Cecil? Catherine, does it? It does. Awesome. And why do I bring that up? Because if they tell me they got to think about it later, I literally say, hey, remember when I drew that thing on the back of the card that said you had to either apply or decline coverage today? That's the reason why I had to draw that out for you. Does that kind of make sense? So for some of you that want to, I don't even know how to screenshot this. Cool. Let's try it. Did that work? Awesome. And then I'm going to delete this because I actually need the space to write. So, okay. So remember that apply, do not apply, qualify, do not qualify, apply or decline coverage. And the reason why it's right here, right? Let me move this. So it's right here. I accept coverage. I decline coverage. You sign your name, you date it, we're good. It's really that simple, right? So that's the reason why I had that on the form. So now that I know their loan information, this is what I'm going to do. They're young. Their mortgage is young. I believe that they could qualify for CBO. So this is what I'm going to do. Okay. I'm going to share this screen from my side now. So boom. Oh, let me pull it up. 1 second. Bank rate. Cool. Share screen. Y'all see this? Okay, hopefully you can. All right, this is an amortization schedule, right? So wherever you go, the numbers will be the same. It doesn't matter. I like using bank rate because their interface is very simple to use. How do you find it? You go to bank rate amortization schedule calculator on Google. It'll take you to this. So their loan amount, $234,000, right? What was their interest rate? Their interest rate was, I want to say it was like a 3.75 is what I think I wrote down, all right? Calculate. I'm going to show amortization schedule. I'm going to show their start date. So they moved in July. Let's say the 1st. All right. Recalculate because that changed the payoff date. So this is what I'm going to do. I'm going to go to year 2045 in the month that I'm in. So I'm in August. So August 2045. Boom, right here. You see this? This is the balance on their loan by the time they're done, or in 25 years, $58,000. And you're saying they have a $234,000 loan, and in 25 years they still owe that much? Yes. Here's why. Because right now, and anybody that's purchased a home before, when you make a mortgage payment, more of it goes to interest than it does principal, and it stays that way for a very, very long time, right? So like, let's just say they pay $2,000 a month for their mortgage. I basically make them grab a calculator and I say, do me a favor, grab your calculator. I don't know if your lender actually showed you this. Put your mortgage in your calculator, 2,100, 2,200, whatever it is. Multiply that by 12, multiply that by 30. And that number is like 400,000 or 500,000. It's usually about 2.5 times what they actually pay for the house, right? And I go, that's what you pay for the house over the 30 years. Your interest kicks in and you pay that first. So your principal doesn't really go down. Does that kind of make sense, Cecil? Yes, it does. So my job today is not only to put coverage in place, but I can help you save 5 years worth of interest by paying off your house early. All right. So how do I get here? And I basically explained to them this. In August of 2045, which is 25 years from now, you will still have a balance of $58,000. You have paid in $150,000 worth of interest into your loan already. My job is to basically save you 30, 40, 50 grand of interest. Does that make sense? Yes, it does. Awesome. So this is, let me go back to the iPad. Share photos. dang it. It deleted. That's not good. Okay. All right. Well, I had all the information on there. Now I'm going to do it from just quoting. All right. So Cecil, so I put in this corner. Okay, pen. So I put in this corner, I put August 2045, 58,306.71. That's what they owe. Okay. I go on my calculator and I work backwards. So I go $59,000 divided by 25 years divided by 12. Okay. So 59,000 divided by 25 years divided by 12. What am I calculating? I'm calculating their monthly premium for 100% cash back. That number is $197 a month is what I have to get them to basically spend. All right. So watch this. So I put Cecil, male, 44, non-tobacco. And then I put Catherine, female, 34, non-tobacco. Okay. Right above here, I put the equity of the home was, I think it was 65K. Put that in a little box. All right. And I start quoting. So the first thing I'm going to run is HMS. Now, let's do this. Boom. HMS, quote.america.com. So I'll put max coverage, 234 natural, 234 terminal, accidental, boom, 25-year premium and cashback. So I'm actually running this on the calculator. Give me 1 second. So 44-year-old male, 234,000, 25-year CBO. What is that number? Perfect. It's 245.40 a month. Okay. So 245.40 times 12 times 25. The cash back is 73,620. Okay. 1.5. The cash, the accidental is 351,000. Okay. Then I do a partial. This. I do max for Catherine as well. So 234 natural, 234 terminal, 351 accidental. What does it cost for her? Because she's a woman and she's younger. Boom, female. 5 year. Sorry, I'm running out of paper. $6 month. 156.09 times 12 times 35 is 46.827. All right, second option, I'm going to go partial. So I'm going to spend for him, for female or male, I'm going to use premium amount. I'm going to say I want to spend $125 a month. 25-year program. What does that look like? So running that number on America, I'm using used premiums about 115,000. So I'm going to put 120. So I'm going to say it's a partial payoff, which it is. So 120 natural, 120 terminal, 180,000 accidental. This is a 25-year program. Premium is $129.50 a month. What is the cash back? $129.50 times 12 times 25 is 38,850 cash back. Okay. Then we go to one more number. Now I usually run 3 numbers but for the sake of this, and I know what the client picked, or I'm going to lay it out to the point where I want them to pick one of these two. Um, I'll show you why. Um, 25-year premium is perfect. This will do 150,000. Premium would be $71 even. So $71 times 12 times 25 is 21,300 plus the 38,850. These cash backs is 60,150. All right, y'all. I'm back. So now that I've ran the numbers and I'm literally sitting in front of Cecil and Catherine, right? Usually, trust me, the page is a lot bigger, so it looks way more neater than this. I'll say, I'll turn the thing over and I'll say, all right, so Cecil, kind of like we discussed earlier, you're the most liable person in this home because if you don't make it home, Catherine and your kids have no idea where to live. Not only that, know how to pay the mortgage, right? Your life insurance policy is cute, but it's work related, so it doesn't really count. So to cover your max, right? Because you remember he brought in $8,000 a month to cover your mortgage at the full amount. Okay, so 234,000 of natural death, 234,000 of terminal illness. Now, what does this mean? This basically means, Cecil, that if you were to get ill, some type of anything that the doctor says you have 12 months or less to live, the insurance company will give you 100% of the death benefit up front so you can use it to pay the mortgage or save your life. Does that kind of make sense? Why do I say this? Because I sell this feature more than the death benefit itself, right? And I say stuff like this in the home. See, so how many people do you know that has or had cancer, right? Oh, my mom, my aunt, whatever it is. Perfect. Now, if that was something that happened to you, the insurance company would advance you 100% of the death benefit up front so you can try to save your family or your house or yourself, right? Why do I sell this feature as well? Because I always tell people don't always lose their homes because the primary income owner died. People also lose their homes because the primary income earner got sick and they can no longer work because they don't have a full-time job because they're ill, right? ALS, cancer, whatever it is. So I sell this feature right here and I share a story. I say, let me share a story with you, Cecil and Catherine. I have a friend of mine, her name is Casey and Scott. They're both real estate agents, made a multiple six-figure income together. When Casey was about 40, she was diagnosed with breast cancer, and she was going through chemo and radiation. And I don't know about you, but she felt that chemo and radiation was killing her faster than it was actually helping her, right? So she decided to talk to her primary care physician and say, hey, I don't want to no longer do, chemo radiation. I want to use like a holistic healing or some other type of treatment plan. Well, their primary care provider said, well, that's not in our network. You got to come out of pocket, which we hear all the time, especially if you're in the medical field, right? So guess what? Now that treatment that she wants to use is an extra $50,000 a year. It's a $50,000 a year treatment. But I tell people, just because you make six figs doesn't mean you have six figs in the bank, right? So her and her husband basically sat in front of a couch. They filmed a video and put it up on GoFundMe. And before the campaign could even end, she had passed away, right? Now, I'll tell that story because I tell my clients, if I say, Cecil, if Casey would have had a mortgage protection policy like this in place, all she would need is a doctor's note to send into the insurance company, and they would have advanced her $234,000 or $234,000 to pay for that treatment. Here's the best part: if you get that money from the insurance company and you beat it, you don't have to pay it back. The policy is now null and void because they rather you be alive than dead. Does that kind of make sense? It does. Do you see, Cecil, why I see so much value in this rider right here? And it automatically comes within your policy. Okay. Now, if you are an engineer, if you were to pass away, job-related death, or let's say you got in a car accident, the insurance company would pay $351,000, so it pays 50% more. Okay. Now, the reason why we ran this at a 25-year even though you have a 30-year mortgage, Cecil, is because the beauty of this plan is if you do not pass away, they give you 100% of your money back. So let me explain to you how that works. We wrote a plan for 25 years. Your monthly premium is $245 a month. Okay, that'll cover the full mortgage, about $1 per thousand. Okay, now, Cecil, you're 44, so 25 years from now, you'll be 69. A lot of people are living and kicking at that time. They're barely in retirement years. I'm pretty sure your parents are around that age and more, right? Yes. Okay, so if you were to buy term, it'd be the stupidest thing you could have done because you would have spent all that money for 20, 25, 30 years, and it would all gone to waste. The beauty of this type of product is that they give you all the money back. So in year 25 of August of 2045, if you're still here and you did not pass away, the insurance company sends you a check for $73,620. Now, let me explain that to you real quick, Cecil. You pay for car insurance, don't you? Yeah. The goal is not to get in a car accident. So like I've been driving for, 15 years and I've never gotten in a car accident. I've never needed to file a claim. But guess what I've had to do? I've had to pay all that money. And because I'm a good driver, I still don't get it back. I'm 30, so like I don't really go to the doctors very often, but guess what? I pay for health insurance. And if I don't use it because I don't want to, because that means I'm sick, guess what? I don't get my money back. This type of product is the only insurance out there, Cecil, where if you do not use it, which is a good thing, right? They give it all back to you. So it's basically a cost-free insurance. It's a glorified savings account. Does that kind of make sense? Yes, it does. Awesome. Well, this is for you. And then for your wife, if you wanted it, it's $156 for her on the bottom. And then I go over to the partial and I say, look, this is the plan that I like better for you, but it's up to you because I'm not the one paying for it, right? So we're going to do what we call a partial. And we do a partial because we do your half of the loan. Does that kind of make sense? So it's $120,000 because your mortgage is $234, right? Same thing, terminal illness, $120, accidentals, $180. 25-year, the plan is $129.50. If you don't pass away, the cash back is $30. Oh, don't do that. If you don't pass away, the cash back is $38,850. Does that kind of make sense? Perfect. But here's the reason why I ran it this way, because then we could actually get something on your wife as well. We'll put a $100,000 policy with her for natural, terminal, and $150,000 accidental. $71 for her because she's cheaper and she's younger. We know that only in life insurance is women cheaper than men, right? Ha ha ha. Okay, got it. So she pays $71 a month. Her cash back is $21,000. So if you took your cash back and her cash back and added it together, it's $60,150 at the end of August 2045. What do you owe on your house? You owe $58,306. So in 25 years, if both of you are not gone, which I don't expect you to be, the insurance company is going to pay off your house literally 5 years early and save you 30, 40, 50 grand of interest. Does that kind of make sense? Yes, it does. Do you have any questions about the plan that I showed you? Usually they ask. If they do, great. If they don't, I say, perfect. Out of these plans that I showed you, which one do you like best? Sometimes they talk to each other. Sometimes they don't. They go, oh, I like the partial. Perfect. You like the partial, then that's the one we're going to go with. I need to see your driver's license and start the approval process. And that's basically it, guys. This is how I do mortgage protection. This is how I sell mortgage protection to a young couple that basically has no medical issues, that has no reason to I can pay off their house early because cashback product is still available for them. They're healthy enough to, right? This is literally how I write cash back. Now, I'm going to go through a few things that I basically see in the home that I want to basically explain to you guys too. If you want to, I'm going to take a screenshot of this so that you can actually see it if I forget. All right. The most common objection that I get with CBO, and see, this is where when you run mortgage protection enough, you kind of understand this. They go, well, does the money that they give you come back with interest? No, it doesn't. No, it does not. It's 100% a savings account. And they go, well, in that case, I can save that money. Well, let me explain to you how that works, Cecil. Let's say, because most people pay an extra payment a year or $100 to $200 a month on their mortgage. Why do they do that, Cecil? Because they can pay off their house 3 to 7 years in advance. That number is usually 5, depending on how disciplined you are. Does that make sense? So let's just say your mortgage is $2,000 a year. $2,000 a month. It's $2,200 a month, right? You make an extra payment a year. That basically equates to what? $200 a month. So if you sent $200 to the lender and you spent $200 to the insurance company, okay? And let's just say you did that for 5 years, right? So you'd pay $6,000 into the lender, right? Your balance is $234, and now the balance is, let's just say, $220 because you paid on top of the principal, right? And you die, right? 5 years later, you die, Cecil, because you got in a car accident and you died, right? Catherine, who's a stay-at-home mom, still cannot afford a $2,000 mortgage with a $220,000 balance on there. Does that make sense? Yes, it does. But let's say you did the same thing. So you put $200 a month into the insurance company and you pay for 5 years, which is $6,000, right? And then you died. Guess what? The insurance company would pay you $234,000. Or if you chose the cheaper plan, $120,000, which knocks down a large part of that loan for you to get one, for your wife to be able to at least try to stay in the home, right? At least she can take the equity out, sell the house, or refinance it, whatever it may be, but that she doesn't lose the house completely. Do you see where dollar for dollar, Cecil, if you send it to the lender, yeah, it'd be great, but that's assuming if you lived. If you send it to the insurance company, assuming that you did die, it's a bigger ROI. Does that kind of make sense? And he goes, yes, it does. And I'm like, it's the same dollar amount and it still achieves the same goal, which is paying off your house 5 years earlier. But with the insurance product, guess what? You have the coverage for 25 years throughout the entire time, right? So that's how I sell. If they say, oh, but does it make interest? No, it's not supposed to make you interest. It's supposed to save you interest, right? Because your loan has a ton of interest on it. So it's supposed to save you interest. I also tell people, like, especially in this case, let's just say that Cecil, which he was a veteran. He was a United States Air Force, right? So he had a VA loan. Well, one thing that I know about VA loan is they're not assumable. So remember how we went through this on the top where his wife and him and his wife, he was the only one on the loan. Well, if he was the only one on the loan and she was a stay-at-home mom, she wouldn't be able to qualify on the loan. That's why she's not on the loan. Her debt to income ratio is way too high. Does that make sense? So, or if they would have been able to put her on the loan, they would have, right? But she made zero because she was a stay-at-home mom. So guess what? Sometimes I have to tell them, hey, not all loans are assumable. What does that mean? That means that if Cecil were to pass away, and Catherine, you couldn't assume the loan even if you wanted to, because VA loans are not assumable. So what does that mean? The only way you can access the equity in the home, which is the $65,000 at the time, right? The only way you can access that is by selling the house or refinancing. Well, how can you refi a house when you make no money? Right? Her monthly income was zero. So therefore, you take that out the picture. She is forced to sell the house. Well, what happens if she's forced to sell the house in a down economy? Then this equity might actually be 30 grand instead of 65. Does that make sense? That's the reason why we're here today, Cecil. So out of the two plans that I showed you, which one do you like best? Right? And then the other thing that I hear in the home often too, and this is, one of the last things I'll say before I open the call for Q&A. Many times we're wearing Family First Life stuff, right? Because we wear a Family First Life polo. Our notebook says Family First Life. Our badge says Family First Life. So they have a loan with Loan Depot and they go, hey, are you from Loan Depot? And don't ever lie, because you'll get in trouble for lying. I always say, no, I'm not from Home Depot, but I do all their mortgage protection. Let me explain to you what that means. It's kind of like when you buy a car, right? Like I drive a Toyota. So Toyota does my loan, Allstate does my insurance. Does that make sense? So in your scenario, Loan Depot does your loan and we will do your insurance depending on which carrier works best for you. The other thing I wanted to talk about is you notice that nowhere on here did I write the word Americo, but anybody that knows what I'm doing is I'm quoting HMS cashback option, right? Why do I not show names? Because I'm not going to let the client go shop me. It's that simple. And if they don't qualify for this product and I have to pivot to somebody else like a Mutual of Omaha, an American Amicable, or a John Hancock, I have to, and I could without losing the sale. All right. So hopefully that answers most of what you guys are wondering what I do in a mortgage protection. Let me stop sharing the screen. So, and unmute the line if I want. So you guys have any questions? Does anybody have any questions regarding what I talked about for mortgage protection?
Nah, bro, I think you killed it, man. I mean, you definitely taught me some, got some extra things that I'm gonna be, putting into my stuff today. So I appreciate it.
Cool, man.
Yeah, I just had a
Hopefully it does.
question. Yeah, really quick. When you were going, when you're talking about telling them that, it's a savings that they can get the cash back, and it's helping them save the interest on the loan.
Mm-hmm.
My first thought was, well, then why don't I just throw that money into the loan?
Simple, because if you just throw it in, it's kind of like what I talked about. Let's say you put that on your loan for 5 years.
Uh-huh.
You put $200 away towards your loan every single month for 5 years. That's $6,000. And then you die, right? Your balance went from 234 to 220. You still have a big balance on your loan. How does your wife stay there when she's a stay-at-home mom making no money?
Yeah, I was just thinking, basically, I'd be like, well, no, you'll get your money back, and through that time, in case anything happened, you would have been insured, and you wouldn't have with
Correct.
throwing it.
That's exactly what I tell them.
Yeah. I mean, overall, it was really helpful. I really thank you, because it made me think about a lot of things. It made me go over scenarios in my head. So that was really helpful.
Good. Glad it did.